Seasonality doesn't seem to be helping the region either. What markets are you less bullish about?
Well, it's really a question of style. I'll come back to markets in a minute. But whilst we broadly prefer value cyclicals to growth, and it's growth stocks that have really driven that poor performance, we think as we're entering a more difficult mid-cycle environment for the global economy more generally, one should be upweighting quality. So that's superior balance sheets and strong profitability. Now, on which markets are we more cautious on? In general, we are cautious on markets where we have a high growth stock representation. And so we did downgrade China, offshore China, and particularly the China internet sector in January. And we continue to be cautious there. But more recently, in this mid-year outlook, we've also downgraded Taiwan, which is obviously a more hardware-oriented market. But Taiwan is trading at a record valuation premium to overall emerging markets, roughly a 50% premium on price to book. And we think this mid-cycle environment, particularly as we round trip the strength in tech spending that was going on late last year, and maybe reconcile what we think is some double and triple ordering that's going on in the supply chain in tech, we think that that valuation premium will erode for Taiwan. So those are two that I'd highlight that we are quite cautious on, China and Taiwan.
So if you have, say, TSMC in Taiwan, you also have Samsung in South Korea, right? And they seem to be also heavy when it comes to those the tech sector. Is that also a concern?
Well, we're neutral on Korea, so our overweights are concentrated in the more value part of the market. So that's Australia and indeed Singapore, so where financials and materials are very heavily weighted. But the Korean equity market, though it is somewhat expensive to its own history, is not out of line with the historical valuation relationship to the rest of EM. Both Korea and Taiwan have had a very strong retail investor bid for equities. In Korea, that's already started to normalize somewhat. The trading volumes have started to come down, margin activities moderated, but that process hasn't really started yet in Taiwan. And again, that's a global theme. It's part of the reason why we got so cautious on growth stocks at the start of the year, because the retail investor had bid those valuations for growth stocks up to unsustainable levels, particularly in areas like China internet.
I actually want to talk about China because we saw the CSI 300 seeing its best day since July last year. We're really starting to see the kind of breakout, regardless of which sector group you're looking at, right? Are you still remaining cautious? Because do you really think that the regulatory overhang has peaked?
So for onshore China, A shares, we have been more bullish than offshore China. So the China ADRs or the dual listed stocks, the stocks listed here in Hong Kong. And the A-share index has a much lower weight in growth and tech than the offshore China indices, considerably lower. And that's a source of advantage for the A-share market. Now, that said, for China equities overall, the bigger theme is that we're in a tightening cycle. And again, 6 months ago, I think investors didn't really understand that. The fact that not just in relation to credit growth, but also regulatory tightening, as you mentioned, there was a tightening move afoot. Now, I think even if you look at bond yields in China, they've started to decline. In fact, recently they've been at lows for the year. So the debate is now moving on, I think, to whether China may in fact be over tightening policy, sort of 15 months or 16 months after the big easing that we saw in February, March of last year.
What does that mean then, given that we have seen consumer names perform pretty well recently? If that overshoot, if you will, when it comes to policy tightening does actually happen, does that have a roll-on effect to the strength and the willingness of that consumer recovery?
Well, if you look at valuations for A shares, which we do prefer to offshore China, they're around 14.5 forward PE, and that's not particularly demanding. In fact, it's at a discount to the offshore China universe. But certainly there are parts of the consumer space in China that are expensive to history and to global peers. So other than continuing with this underweight that we've had for some time on growth internet, we also in parts of consumer discretionary are cautious. And so what do we prefer? It's financials, And it's been a long time since we thought that financials would outperform within China, in fact, within the Asia region generally, also materials and parts of capital goods and industrials.
Jonathan, given what you're saying about financials, your preference for value and cyclicals, I would have thought you would have liked Japan, but it seems you're less bullish now.
Well, if you go back 6 months ago, we had a preference for developed markets overall, including Japan, but Japan, Europe and US versus emerging markets. And that was 180-degree different from where the consensus was, which expected emerging markets to lead a kind of global cyclicals rally this year. Now, that thesis went wrong because of the Chinese tightening, went wrong for the consensus, and also this sort of derating that we've had for the growth tech internet part of the MSCI EM index. Now, to answer your question about Japan, Japan has performed less well than Europe and US. Europe is actually the key region that's outperforming. And I think you were mentioning on a previous segment, one of the reasons for that and why we're now more neutral, Japan versus emerging markets, is that Japan, in terms of COVID vaccination, has lagged other developed markets. And indeed, we've cut our Japan full-year GDP growth forecast for this year. So Japan will probably grow a little bit over 2% or so in real GDP terms, Europe about 4.5%.
Right.
The US will be north of 7%. And that's an enormous divergence.